Hello and welcome to Macro Monday. Today we decided to fire up a little bit late. I wanted to see what was going on with futures, to see how the market was reacting in order to give a bit of a better appreciation of what was going on rather than just speculating around how markets would act as commodity markets opened and the S&P futures opened. We're all good to go. We are ready to check out what's going on and how markets are reacting to this. Let's go straight into it. I'm going to share my screen here and we're going to go and start looking at how markets are reacting post strike. Obviously, it's been a few days of activity now in the regions, and over the recent past, we have seen markets reacting interestingly. So let's start off with gold. Gold popped as the markets opened, and as you can see, similar story for oil. And if you were to go to a different commodity like wheat, you would see that basically markets opened real strong bid, but have given it all back. So that's an interesting sign for how markets are anticipating and kind of thinking about these things. So I think we're looking at, I think it opened like 12 or 13% up in the case of oil, and now we're only down to up about 4.64%. So, you know, perhaps markets are not too concerned about the state of commodities, and maybe they're saying, hey, it's not as bad as it looks. You've got to bear in mind these strikes were done on Friday, and markets and participants are trying to deconstruct what it means. And again, opposite story for the S&P futures, get gap down, and it is really kind of roaring back, as you can see over the last couple of hours. So futures have been open for 3 hours, gap down, and then you're seeing the price come back here a little bit. Interesting as well would be Bitcoin. You will observe, so this here on my chart, so I get rid of these. This was when the strike started. Bitcoin dropped sharply and found its way above where it started when the strike started, and then has come down, and then is still above again where the strikes took place. So depending on your views around Bitcoin and what type of asset it is and what that means, I think is for some debate and some thought. If it is a risk asset that is just high beta and it's very correlated to the NASDAQ and so forth, then perhaps markets are saying that this is not going to be too much of a big deal. If it's a safe haven asset where people run in safety and uncertainty, then maybe you would interpret it that way. Maybe it's both, maybe it is neither. But ultimately, I would say that if this seems to have a similar sentiment from the S&P futures, more so than an oil, which is looking gross, or a gold, right? So oil and gold pumped pre-market, pumped on open, and then has sold off since that open. And then in the case of the S&P, it dumped on the open and is regaining some of its footing. And I think that's a similar story to what you'd observe from the price of Bitcoin in this case. And obviously you had the weekend to see some further price action to what you would get in the traditional equity markets that were closed over the weekend. Something I've observed is that any major moves that governments want to take, they typically try to work it around market being closed so that the participants have time to digest. And that's exactly what we've seen here. We've had strikes over the weekend. Bitcoin, obviously, as it's open, dumped, but the market has gone backwards and forth on how they're anticipating the more longer term situation could be. So really, that's kind of the long and the short of it. Commodities have opened strong, but they're giving it all back. Equity market opened weak, but it's regaining some of its stepping. And I would say you'd observe that Bitcoin has been rather resilient given what has just happened. Okay, so if we were actually look at the commitment of traders report, then we move on to the commitment of traders report, which is interesting because you'll see how people were positioned going into the weekend. Every week, this is a report that basically tells you where traders are positioned, commercials being hedgers and commercial banks, and liquidity providers, in essence, smart money, large speculators being funds, hedge funds, large accounts that are speculators, and then small speculators, which would be retail. And what does something interesting? We're starting with Bitcoin here. Is last week commercials did reduce their net short exposure, while retail went short. Interesting, and large speculators basically got out somewhat. So is this a turning point for Bitcoin? It's an interesting thought experiment, as we've also just seen how the Bitcoin market reacted to these strikes and then post strikes. So, definitely something to consider and think about. Let's move on to the S&P 500. Let's see how the positioning was there. Oh, interesting. Again, commercials getting longer, large speculators getting shorter. This to me has all the characteristics of um, people too bearish getting short and getting caught off guard. Um, and the commercials are getting longer, the S&P, at least for now. So I definitely think that is interesting, especially with all the negative news we continuously hear over the last couple of weeks. Yet commercials are ending up net long, and in a larger way than it was last week, despite obviously this weekend. Maybe they got caught off guard. However, it wasn't exactly a secret. This Iran situation has been building over the last couple of weeks, really. So I think it was a well telegraphed move. I think it was just a question of which weekend were they going to strike rather than if they were going to strike. Let's take a quick move over to um, our some oil, crude, WTI. So again, large speculators, they're getting shorter. Large speculators are getting longer, but commercials are getting shorter. Um, Small speculators also getting longer oil. I mean, this is an interesting dynamic here, right? Because energy's been bullish this year. However, commercials are increasing their net short exposure in oil. Very interesting. And let's just take a look at treasuries. Let's go 20-year, see how we're getting on. 30-year T-bond. Let's see what the futures look like. Wow. See this? This is retail, so small speculators getting longer and longer long-dated treasuries, while commercials are getting shorter, and large speculators are kind of net even-ish, a little bit long, a little bit short. So retail scared is maybe how you'd interpret that, and they're kind of rushing to long-dated treasuries. Commercials are increasing their short exposure. So that again is a very interesting point. Well, if we go back to the TLT chart here, which is the 20-year plus ETF for treasuries, right here. Obviously, the market's closed right now, but you've seen from the low, which was I think in about early Feb. So over the last month, let's just make it a one day chart. The appreciation of the TLT, which is the 20-year plus Treasury bond for the US, is up 5%. Meanwhile, Small speculators are kind of getting longer and longer this thing, but commercials are shorter. So why are commercials shorter, I think, is an interesting question to be asking. And I also watched an interview over the weekend from Stanley Druckenmiller, who basically has a view that there is a risk that inflation comes back, and essentially he's short long dated treasuries in order to remain long the equity market. Um, and I felt initially that that was an interesting play, and now seeing the commercial report and seeing again small speculators continuing to get longer this thing, but commercials and large speculators aren't following. I do find that an interesting dynamic. Let's now just take a look at gold just to see. Now, remember, these things are relative. So commercials are always short gold because they are hedges, but it's the relative changes that I think are interesting. So not much to note here. Um, that's probably most of what we want to be seeing. We can take a little look at wheat here, just because I haven't actually taken a look at the. Oh dear, interesting. So this is interesting. Basically, a lot of open interest has fallen off by the looks of it, and um, yeah, commercials are much less long. That's an interesting dynamic, and large speculators are much less short. So a big shift there in terms of open interest and what market participants are doing. And then let's just end on talking a little bit about the earnings plays of the week. So we've got a list here of all the companies that are producing and reporting earnings this week. We got some big players in the AI and SaaS space. We have some semiconductors, some kind of, so we got Costco, which is quite an interesting one, and a few others. So there's a bunch of earnings coming out this week. What are the most interesting to watch? Definitely the software companies still. I think that's a really interesting one, kind of like MongoDB is an interesting one to watch. Asana, to see if the SaaS apocalypse is still continuing. GitLab is an interesting one. It's given away a lot of a lot of where it was a year ago. Yeah, it's really come down a lot. GitLab is a worse product than GitHub. I think a lot of the tech community that deliver software and work with software seem to favor GitHub. It's just a shame that it's owned by Microsoft, really. I would love to use GitLab, but the product is nowhere near as good, unfortunately. Otherwise, I would definitely have us on GitLab instead. What else? What else? Wix.com. I find some of these clunky web CMS providers as very much at risk. They obviously have the distribution and can adopt all of the new software to help their customers build better websites, but they are sitting on a lot of technical debt, and they're very expensive for what you get, in my opinion. So definitely going to be tuning into the Wix earnings. And then, you know, Costco has been an absolute beast. It's trading at a really high multiple of 54. And again, the market is basically pricing that Costco, Walmart, they're going to be there in the future. Whereas I don't think that same conviction exists for an Adobe or a Wix or an Asana. So I think that's where the market is really kind of seeing itself, and kind of that's where the positioning is. Broadcom's a very good one to watch, considering it's one of those big semiconductor plays. It's off quite a bit from the high of just over $400, but it's still trading at a 67 PE ratio. So definitely one to watch. And if you like looking at speculative Oh no, Okta is an API company. There's another company, I can't remember the name, that's a energy player. I thought that was it, but it's not. Um, anyway, just wanted to get an episode in this week post futures opening. I think the overall kind of message here is that we had the US strike on Friday, late Friday after the markets closed, and now it's open 56 basis points down. So you know the market either doesn't see it as a risk that is systemic or negative for US equities or US and the US equities, um, or as being complacent. So I guess time will tell there. Anyway, we hope you have a good week, and enjoy what's going to unfold, or be kind of super concerned and worried for the people that are actually affected. I think ultimately, as people that are far away from the action, there are real consequences outside of price movements of assets and commodities and speculative activity. So that's probably something we need to all think about. But you know, when there's a lot of change, it's a very exciting time for markets and a very interesting time for markets. So have a great week, and we will see you next time.